All right, and we're live. Uh, Welcome everyone to another show of the Real Estate Investor or the Savvy Real Estate Investor Show. Yona Wise, he's with us today. He is a powerhouse with property owners tax savings. As a business director at Madison Specs, a national cost segregation leader, he has assisted clients in saving hundreds of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and a host of the top podcast, Wise Advice. I love that. Jonah, welcome to the show.
Thanks so much. It's great to be here. Appreciate you having me on.
Dude, I've been wanting to get you in the show because you're what you do in real estate is very powerful, and a lot of people know that one of the uh, best benefits in real estate is the tax benefits,
Hmm.
but they just don't know really how that comes into play. How does it even work? Is it legal? There's a lot of questions out there, and most of our audience are busy professionals that obviously they're not. The real estate is not their primary focus, right? So they invest with us because they believe in us, they trust us in what we're doing. So I'm pretty excited about digging into this so that they're more aware of what's going on. How is it that they're saving money via cost segregation study, which is you're the cost segregation king, right?
That's what they call me. Yeah, it may or may not be a self-proclaimed title, but regardless, it's true. This is a topic that gets a lot of interest, and like you said, real estate is so great for many reasons, but one of them is the tax benefits. But if you don't understand what cost segregation is, you don't really understand what the true tax benefits of real estate investing is. And so that's why I love just sharing the information, sharing especially for people who are passive investors, that you may not have another type of investment vehicle out there that you can potentially be paying little to no taxes on the income produced from that investment. It's just mind-boggling. So, I mean, there's more to it than meets the eye. It's not a simple topic, but I'm happy to explain and kind of break it down and make it simple for everyone to understand.
Love it, man. Let's peel the layer back a little bit more, just one step back, and let's bring us back to how you started doing this.
So, how I started doing this is a little crazy story. I had a background in teaching, and so it's really my passion. I was a teacher for about 15 years and worked in nonprofit industry. But I was pulled towards real estate at a certain point and just started getting my feet wet, asked some friends, and was doing some fix and flips. I did some brokering and just started learning everything there was to know about real estate and especially commercial real estate. And I had an offer, like an opportunity come to work for this company, Madison Commercial Real Estate Services. Madison Specs, the largest national cost segregation company. And I happened to know some people that work there, and they were looking for someone to take on, business development role. And my background was in teaching. And I wasn't really sure about it, but I started asking a few people. And one of the people that I spoke to was a mentor of mine who was actually a client. He's, a person who has been in commercial real estate for 25 years, a huge, developer, investor. And I asked him, hey, this thing called cost segregation? He's like, yeah, of course. I love it. I do it in all my properties. And I was like, oh, that's amazing. So I said, I think I should work for this company. He's like, it's a great opportunity. And I was like, okay, well, let me ask some more people. And I asked some other friends of mine who were in real estate, and they had never heard of cost segregation. So I was like, oh, this is really interesting. You have someone who's been in the industry for 25 years, and he's like, yes, it's the best thing ever, and I do it all the time. And the other people who are more newer, maybe have been in the industry for 5 years or so, I'm like, I have no idea what you're talking about. And I found that was, an opportunity, that it was really the reason why people didn't take advantage of this tax benefit is simply because they didn't know what it was. They weren't aware. And so I found a huge space of people that just didn't know it. And I found myself just teaching. That's what I'm doing. I'm on podcasts every day. I'm doing webinars and sharing on social media these concepts that are really a little bit complicated, but are so important for every single real estate investor to know. So I'm just doing what I always did, which is teaching. So that started about a little over 5 years ago.
Cool. So that awesome. So let's break down before we go any farther into this. Let's break down exactly what cost segregation is.
Absolutely. It's a weird name for a tax benefit. Okay. It's essentially depreciation. So, depreciation, we'll take even a further step back to understand what depreciation is. It's a tax deduction named for a principle. Okay. And this principle says that things go down in value as time goes on, right? But depreciation, when it comes to taxes, doesn't actually mean that. It's just a borrowed term. The IRS gives you, as a real estate investor, if you buy a property, as long as it's not your personal residence, any business or investment property, you're allowed to take a tax deduction of the total value of that property. Okay, so if you bought a property for $1 million, you can now take $1 million tax write-off. A certain amount you can't because it goes to land and land doesn't depreciate, but the remainder, the majority of it, is literally a tax deduction. You can't take it all in 1 year, so this depreciation term just means that we're going to see that this property is going to go down in value for over a 27.5-year period or a 39-year period. And essentially what we're doing is taking a little bit every single year as a tax deduction. So that's what depreciation is. Now, it doesn't mean that the value of your property is actually going down because it's a borrowed term. It starts over when you buy a property. For every new owner, this deduction and this schedule of 27 or 39 years starts over. So again, it's not intrinsic to the property actually losing value. It's just, like I said, a borrowed term for this tax deduction. And that's what depreciation is. And this is probably one of the greatest benefits when we're talking about tax benefits is this deduction, because literally you can wipe out, a large portion of your income just from this deduction. And again, it's just a paper write-loss. It's a paper, some people call it a phantom deduction because it doesn't really mean anything. However, what cost segregation is breaking down that depreciation even further so that you can get bigger tax deductions in the earlier years of ownership. So the word literally means like cost. We take the cost, how much you paid for the building, and we segregate it and we break it down into different buckets or into different categories. Certain components of the property depreciate on that long 27 or 39-year schedule. Those are the structural components. But there are other things inside and outside the building that actually depreciate faster over a 5 or 7 or 15-year period. And what we're doing is we're identifying through an engineering process what those components are, and we're taking an accounting. And that's where the accounting and the tax side comes in. And we're able to take a tax deduction based on the value of all those components. So just to back it up, make it even simpler, cost segregation is an advanced form of this depreciation. And so it allows you to take bigger tax deductions in the earlier years of ownership. And so that's all we're doing.
So what will be some of the things that are 3 to 5 years, and what are some of the things that will be 27.5 years?
Yeah, absolutely. So again, all the structural components depreciate on the 27.5-year schedule, right? The roof, the walls, doors, windows, right? Infrastructure like plumbing and electric, the foundation. But when you come to things that are on a 5-year schedule, that's anything that's interior that's non-structural. And this can mean appliances or furniture, fixtures, shelving, countertops, cabinets, even flooring like LVP or carpeting, anything like that, anything that's non-structural. And so it doesn't necessarily mean whether it's attached or not, because things like millwork or window treatments, all those things depreciate on a 5-year schedule. So what we're doing is we're coming in, identifying how much is there, like you have, 10,000 square foot of carpeting. We're going to take a tally of that and what's the value of that, per square foot. And now we're going to take that value as a tax deduction. Instead of a little bit every year, you can now take this big write-off over the first 5 years. There's other things outside the property called land improvements that depreciate on a 15-year schedule. So again, more accelerating of that depreciation. That's things like concrete or pavement. If you have a sidewalk or parking lot or driveway, all the value in the concrete actually depreciates. So the land doesn't depreciate, but what's on top of the land does. So like landscaping or fencing, anything, you have some of these beautiful garden-style apartment complexes have beautiful landscaping. You may have like palm trees and kind of stuff like that. That's very expensive. A lot of that can be depreciated and taken as a faster deduction. And so it's really, really beneficial.
So how does it look like so we focus on multifamily syndications, right? Most projects are 3 to 5 year cycles. How does it look like if we do a cost segregation study, compressing all that within that project specifically?
Yeah. So what you're doing is you're pulling out those accelerated depreciation deductions into the earlier years. And it's become even more compressed with this thing called bonus depreciation, which allows you to take all of those accelerated deductions in the first year as a huge lump sum. So, how that looks like is usually taking all the income that's being produced from the property over those first 3 to 5 years are going to be covered by these depreciation deductions. What I mean by covered means there will be zero tax liability. You'll have maybe, let's say, $10,000. Let's say, just make it simple. You put in a $100,000 investment in a property, you're getting a 10% return. That means you get $10,000 in your bank account, and you're going to also get allocated to you a certain amount of depreciation according to your investment. And let's say it's going to be 50% of that. You may get $50,000 of depreciation deductions. You're going to be paying zero taxes on that and have an extra $40,000 left over that can either be carried forward, you can use it next year, or if you're a real estate professional, if a broker or a property manager, anything like that, you can actually use that against your active income as well. So it's going to be beneficial. And then to answer your question about what does that look like for that time period, when you go to sell the property, you're going to have the gains, right? Meaning you're going to have the returns. Usually that's the big lump sum of returns that are going back to the investors. But at the same time, you're also going to have this capital gain, meaning you're going to have a capital gain tax as well as what's called a depreciation recapture tax, which is an unrealized gain. So you're going to have a large amount. Yes, you're taking these deductions up front, but you're also going to have a tax upon the sale. And usually there's going to be enough losses to offset those gains, meaning enough deductions that carry forward through this conservation process that you can actually, with these losses, this kind of bucket of imaginary deductions that's not used, can actually offset the gains from that sale. So it's actually a beneficial thing, not only in the years of ownership, but also in the year of the sale.
So, and I don't want us to go too much into tax
Yeah, right. It's
stuff
kind of
because
people
we
are
don't,
like,
we're not,
what's going on?
yeah, this is not, and then we're not, this is not tax advice for some of you guys listening, right? Just consult with your own CPA. But I'm very interested in this. So even if, so like for the example that you gave, right? You were getting a $10,000 cash flow a year, and then you still had like $40,000 remaining to depreciate. So you carry those forward for the following years. But let's say the property sells the next year, right? So instead of, it was originally a 5-year project, but it sold in year number 2. So those $40,000 can be used against the capital gains. Is that kind of what I'm understanding?
That is correct. That's absolutely right.
So then your overall tax liability by the end of the project will be less once you're.
100%, much less, much less. And that's really the main advantage here. I mean, we talk about tax benefits. One of them is this depreciation, but it actually has multiple roles. It has the role of offsetting the income, but also as the passive income from your properties. And so in the years of ownership, you're not going to actually be liable to any taxes on that income. And this is, I mean, think about, do you know of any other investment vehicle where you're getting money in your bank and you're not going to be paying taxes on that? So that's one aspect of it. The second aspect of, in the interim, even before you sell, let's say you do what's called a refinance. A lot of people do this thing called a refinance, a cash out refinance, where many times the syndicators will pay back a portion or the entirety of the investment back, or some of the capital at least, back to the investors. Well, that refinance is tax-free, meaning the money that's coming back from the refinance is not going to be taxed either. So that's another point. And then in the sale, the third aspect of it is in the timeline of the investment is on the sale. Like you said, you will have, hopefully, if you made money on the property, a gain, and you'll have that capital gain. Now you can defer that with 1031 exchanges and things like that. A little more complicated when we're talking about syndications, but real estate in general, that's what you can do. However, if you don't do that, you still may have enough losses from these deductions, these depreciation deductions through cost segregation, to have those losses offset that capital gain as well. So it is kind of a full cycle of these investments getting tax benefits.
Wow, that's powerful. That's powerful right there. Can anyone, if you're not a real estate professional, can you still take advantage of this last part right here that you explained, can you still carry over those losses for the capital gains? Is that a sort of like blanket to everyone or just real estate professionals?
That is blanket to everyone. Passive losses will offset passive gains. That's across the board. The only real difference between the real estate professional and someone who is not is whether or not you can use these passive deductions, these depreciation deductions, to offset your W 2 or your active income. So, typically speaking, the depreciation is going to be in a separate category, is just going to be used to offset your rental income or your passive income from your rental for your investments. And that's a benefit in and of itself, as we discussed. To the really added benefit is for those who are real estate professionals, because now you can actually use those deductions to offset your active or ordinary income or your spouse's income as well. So only if one of you is a real estate professional and the other one is a high W-2 earner, you can actually use this to your benefit to pay little or to no taxes on your W-2 as well.
Wow. I don't know that. That's awesome. So is that because you're filing it jointly? So if you're filing jointly, then you can still use that towards the W-2.
Exactly. Well, even if, to be honest, even if you're not filing jointly, but you are spouses, it still can roll over.
Wow, that's awesome. Is there do you find that there is any syndications out there that do not do a cost segregation study?
I'm sure there are. I have yet to find them. But to be honest, no, there are a couple instances where it would not be beneficial. And one important thing to note is that, yes, we talked about the recapture tax and we talked about the benefit. The time value of money of real estate, of this depreciation deduction, is really the main thing. So if you are selling within a very short period of time, let's say within a year or two, then the benefits may not be as strong because you're going to get these deductions, but you're also going to have that gain on the sale. And the shorter time you wait, the more gain there will be. Okay, it sounds funny, but that's because you're taking bigger deductions up front, and then you're just going to be having that gain on the sale. So you may have less there. So that's one case where I'd say you may not want to do it, is if it's a very short hold. And the other case is where you're investing through retirement accounts. And this is very popular, and I highly recommend if anyone has a retirement account, they look into how you can self-direct your IRA or your 401k. There are many companies that do this, and it's extremely beneficial. Because why are you just letting it sit there and losing money in your stock or whatever? I'm not going to get into that. But if you are doing that and self-directing that, investing in syndications, it's already in a tax shelter, which means you cannot benefit in many cases from the depreciation. So I know some syndicators that they take all of their money from people investing through the retirement accounts, and they can't benefit from the depreciation, so they just don't use the cost segregation.
Got it. So the first reason why you said that it might not be beneficial is when it is a short time span, right? So is there a time frame? What would be more of a tangible thing that you can sort of think through that say, okay, this at this point, from this point forward, it will be beneficial, and less than this, it will not.
So usually I recommend if you're holding a property for any more than 2 years, it's for sure going to be beneficial. If it's less than that, it's questionable. And it really does have to do more than anything with your overall portfolio. Now, if you're looking at a syndication and you're talking about investors and everyone's kind of on an individual thing, right? You're in one investment and that's it. Or maybe you're in another one, but it's not connected to the first one. As opposed to someone who is a real estate, investor on their own and they're building their portfolio and continually buying more properties. Even if you hold one for a short period of time, you're still going to buy another one the next year or that same year. And so the losses are just going to keep rolling forward and you're never essentially going to be paying taxes on it. So in a case where the syndication is a little more complicated, I would say at least a 2-year hold period. Anything after that is for sure. But a shorter hold period, it's more questionable.
Got it. Got it. That's just and then just to recap that's just because there will be a pretty big capital gain on the backside. So you take all the depreciation up front, and you cannot use if you took all the depreciation up front, you cannot use all of that to offset that big capital gain on the back.
Not necessarily, because again, it's going to be you're taking some losses, and then you're going to be hit with that tax of the gain on the sale. So you may not have enough because of that gap, and there's not enough time that's being spent.
Got it. Is there a minimum property size that you recommend, like people like a single family home? Is it worth doing a cost segregation for someone out there buying single family homes, or is it only like 100+ units?
Yeah, it can be for anything. It literally can be for anything. We've done, a tremendous amount of single-family homes. I would say when the lower the property value or the purchase price, the less beneficial it is. So anything over, I would say, $200,000 to $300,000 purchase price, definitely something to look into. If it's over a $500,000 purchase price, it's a no-brainer. I mean, the benefits are 10x of what the cost of getting it done. But you do have to realize there is a fee, there's a cost in getting something like this done, and you always want to make sure that the benefits are going to far outweigh the cost, right? You wouldn't spend some money and then just get the same amount back. You're just kind of churning water at that point. You're not really getting
Right.
anything out of it.
Right. Yeah, I sort of look at it as in spending money on a good CPA, right? It may be expensive, but the benefits from the things that they're able to um, save you money from paying taxes on outweighs the cost of the good CPA, right? So same thing with this.
100%.
And dude, I'm surprised that $200,000 house you can do this out, just from only doing big multifamily syndications. I never really consider I for sure thought it would be more like $1 million plus home, but didn't think of it as a small single family home. What what are the costs? What's the general cost of, like, let's say a 200 unit plus apartment complex on? And now you don't have to give me something specific, but maybe just like a ballpark of what
Sure.
it costs to do a cost segregation.
Yeah, absolutely. So it's not contingent on tax savings, right? It really can't be, meaning the IRS doesn't want to see a third party coming in and saying, oh, we're going to save you $1 million and we're going to take a cut of that. No, that's really not going to be so objective at that point. So it is a flat fee. We charge currently, and again, inflation is crazy. So I know that our costs have gone up over the past year or two just because of everything else going up in price. But currently, about a 200 unit multifamily property would cost somewhere in the range about $5,500 to $6,000 for us to do a cost segregation on. That's again current pricing. Can't speak to what it'll be next year or 5 years from now. But I actually got myself in trouble. I was on a podcast a couple years ago, and we were doing single families. We did Airbnbs, and we're like, yeah, we're doing this for like $2,000, and really small single families, and like tons of people started reaching out to me, and then like a year later, people reaching out to me. We heard you on this podcast, like, sorry, our prices actually went up from the time of the recording of that podcast. So I want to be careful of that. It's not going to cost you necessarily the same thing it will next year. Just like you go to the grocery store, try to buy a loaf of bread, right, or a pound of meat for the same price you did a year ago.
Yeah,
Unfortunately, it's not going to happen.
yeah. Don't come back at us, guys. This is August 8th, 2022. Whenever you're looking to do it, don't come back and bite us. You mentioned earlier 27 and a half years to depreciate to do the cost segregations. The amount of years you can depreciate something versus 39, right? What's the difference?
Right. So for multifamily or residential properties, the IRS has given a lifespan of 27 and a half years. For commercial properties, anything that's not residential, it's going to be a 39-year schedule. So these are kind of arbitrary numbers. I have no idea why they came up with these numbers, but apparently commercial properties last longer for whatever reason than residential properties. Maybe there's less wear and tear. I'm not really sure. But something really interesting, and this has become popular recently with more Airbnbs coming up, and tons of people doing these on Airbnbs or short-term rental properties, is short-term rentals are treated like hotels in the regard to commercial. And so there's a 39-year schedule for the depreciation.
Wow, that's pretty interesting. So we have a short-term rental fund that we're working, and we're doing a cost segregation study. So we're actually gonna do a we're gonna be able to depreciate up to 39 years and compress it into 5 years, right? And I may be confusing the math here, but which one ends up being more beneficial? I'm assuming 39, right?
It's going to be more beneficial actually for the 27 and a half. Well, there's really two sides of looking at it. For the 27 and a half years, it's going to be beneficial because you're compressing the value, say $1 million over a 27-year period. You're able to take about $30,000 a year.
Mm,
When you're looking at a 39-year period, it's closer to about $22,000 a year of depreciation. So there's there's that. But then when you're doing the cost segregation and compressing a certain portion of that into a 5-year period from the 39-year standpoint, it's actually more beneficial. So either way you look at it, it's good to do.
Yeah. So that's interesting. So short-term rentals are considered as hotels per the, I guess, at the IRS tax code. Is that what it comes down to, right?
Correct. For depreciation
For
purposes, correct.
depreciation. Got it. Got it. Well, that's pretty interesting. The I forget what I was going to go with this, but um, you said something there when you were telling me about the short-term rentals and the commercial. I think we were talking. I think I don't know, man. I forget now, but we can go back if I think of it again. How long does it typically take to do a cost segregation study?
It will take us about 6 to 8 weeks or so to get it done. It's not necessarily saying that's how long it can take, but just in terms of our service in my company, Madison Specs, we're the biggest national company, so we're doing about 5,000 of these a year, and so just the volume of turnaround in our team, we only have a certain number of hands on deck, so it does take. We can get it done, let's say in a week or two, but the whole process is and make sure that everyone reviews it and does all their work on the property. It's about 6 to 8 weeks.
Got it. Got it. Man, I can't believe the price that it costs to do this versus the amount of benefits. Because you're essentially, I mean, if we're doing a $75 million deal and it will cost us the price that we mentioned earlier, I don't want to keep
Right.
pounding it because,
Yeah, no, a
but
few $1,000s is crazy. You get like millions of
yeah,
dollars of tax benefits and pay
yeah,
for a service to do that.
it's no
Uh,
brainer.
yeah, it's exactly.
No brainer, dude. I love what you're doing out there. It's funny that I did not know you work for another company. I thought you were you. I thought you were the company. I thought it was your. It was you were the guy, and I think
Yep,
that's what you're doing, and you're doing an excellent job at it, right? Because everybody thinks cost segregation, they think Yana, right?
yep,
So that's awesome, man. I love what you're doing. I love that you're going out there and helping people implement this strategy. That is very powerful. Dude, we're reaching the end of the podcast here, but what I want to ask you the two famous questions, which is one, if someone is just wanting to get into real estate syndications, whether passive or active, what would you recommend them to do?
best thing to do, first of all, is learning. You want to make sure you're learning. And so, listening to podcasts like this or reading about it, asking questions. There's so much information out there. I mean, you can literally become an expert on YouTube or wherever platform you're listening to and ask questions. And the second thing that goes along with that is network with those people, learn from those people who have already done it. There are plenty of people out there who are in this space and are very giving, really, truly, from their hearts, trying to help other people. And I'm very grateful to be part of this kind of community. So get part of a mastermind of some kind or a part of a group. Whether there's these Zoom meetups or local meetups, real estate investment groups, things like that. Your network, is really, they say, kind of cliche, your network is your net worth. But the truth of the matter is, it means that the people that you surround yourself with, the opportunities that come from that is beyond what you could without them. And so I think that's really what it means to me. And just to reiterate that, there's so many people out there willing to give their time and their advice. Just reach out.
Dude, love it. I wanna ask you one more thing before I ask you the other question, which will be the last one. But
Sure.
um, would you recommend anyone that invests in a syndication to be someone that does their own taxes, or would you 100% suggest that everyone uses a CPA because they'll receive this K1 forms, right, with losses, and I'm assuming I don't do mine myself. I wouldn't even know where to begin to do that, to do
Right.
my own taxes with it. So what would you recommend the general population?
Like you said earlier, paying for a good CPA is worth every dollar for sure. Now, I'm not saying that someone can't do their own taxes. There are plenty of smart people out there who understand accounting, do your own taxes. More power to you. I think obviously the more you're investing, you're getting K1s, getting other forms that are going to be carrying forward losses and things like that. It becomes a little more complicated. I'm not going to lie. It's a lot more complicated than just filling out your TurboTax, your W-2, 1040, and that's it. You're done. So definitely probably worthwhile making sure you have a CPA do it. I don't necessarily say that you have to, but it's probably worth it.
Cool. Love it, man. Dude, last question. If you have to recommend someone one real estate book, which one will it be?
The best real estate book that I would recommend anyone, to be honest, there's so many out there, it's really hard to tell. But from a real estate investing syndication standpoint, the best ever book by Joe Fairless, the best ever syndication book, literally just walks you through a step-by-step process of everything you ever wanted to know about investing in a syndication, running a syndication business from A to Z. And obviously, he has his own way of speaking to it, right? With the Thought Leadership platform, he's very focused on the marketing. He comes from a marketing background. But that being said, probably one of the best kind of encyclopedia books on the subject.
Yeah, yeah, I agree. I've read the book, and even if you're going to be a passive investor, even though there's a lot of active information and guidance, I think it will still help, 100% to know everything that goes on. Um, how can people find out more about you?
You can find me on LinkedIn. That's where I'm most active. I'm on pretty much all the social media platforms, but you can find me on LinkedIn, or you can go to my website, yonaweiss.com, and happy to, connect. Feel free to give me a note if you want to reach out on LinkedIn. Tell me you listen to the Savvy Real Estate Investor podcast. I'd love to hear that.
We're happy to have you today, man. Thank you for coming.
Thank you again.